So you're currently paying for mortgage insurance every single month. And here's the thing. There's a real chance you don't actually have to be anymore. Your servicer knows that, and your servicer is not going to call you up and volunteer to tell you that. Now, I want you to really pay attention here, because there's a specific letter, a written request, sitting unsent in most people's inboxes right now, and that one letter is the difference between paying this for years longer than you legally have to, or ending it today. This involves federal law. It involves precise percentages. It's dense, and I'm not going to apologize for that, because dense is exactly what actually saves you real money here. So save this video right now. There are three specific numbers that decide exactly when this ends for you. Let's start with the law itself. Okay, so let's start with what mortgage insurance actually is, because you cannot fight this letter until you actually understand what you're fighting. PMI, private mortgage insurance, is what you pay when you put down less than 20% on a conventional loan. It doesn't protect you, by the way. It protects the lender in case you default. But you're the one paying for it, every single month, on top of your regular payment, for years. Now here's the part that changes everything. This isn't just something your lender decided to do to you on a whim. This is federal law. Specifically, the Homeowners Protection Act of 1998. It covers borrower-paid PMI on conventional loans closed on or after July 29, 1999. Objection! I know what you're thinking right now. Isn't this just up to my lender, whatever they feel like doing? No, it is not. The federal government set a floor here, a legal minimum standard, and your servicer cannot make that standard any stricter than what the law actually says. They can't move the goalposts on you. Now, one thing I need to be really clear on before going further. This law, the HPA, does not cover FHA loans. It does not cover VA loans. It does not cover USDA loans either. Those run on a completely different mechanism, and we're coming back to that later in this video because it matters a lot. So here's the thing most people get completely wrong. They assume ending PMI is some kind of courtesy from their servicer, a favor being done for them. It is not a favor. It is the law, plain and simple. And the law gives you three specific numbers that decide exactly when this ends for you. Let's get into them right now. Okay, so, three numbers, 80, 78, and the midpoint. Let's break down each one of these carefully. Number 1, 80%. This is borrower-requested cancellation, and it starts with you. Once your loan balance is scheduled to reach 80% of the original value of your property, based on your original amortization schedule, you can submit a written request to cancel your PMI. And if you've made extra principal payments along the way, you might actually hit that 80% mark earlier than the schedule says. That's on you to notice, and that's on you to request. Number 2, 78%. This one is fully automatic. No exceptions, no request required from you at all. Once your balance reaches 78% of original value, your servicer must terminate PMI on their own, as long as you're current on your payments. This one simply happens. Number 3, the midpoint of your loan term. If PMI somehow hasn't already ended by then, it must terminate at the exact midpoint of your amortization period. Year 15 on a standard 30-year loan. This applies even if you never requested cancellation and even if your home's value actually declined. As long as you're current, it ends there. No exceptions, no appeals needed. 80, 78, midpoint. Now say those three numbers with me. Now you might be thinking, if 78 is automatic anyway, why does the letter even matter? Because 80 arrives first, often years earlier. And nobody is sending you a reminder for that one. That's real money sitting on the table every single month until you send it yourself. So what actually counts as being current? legally in the eyes of this law? That's exactly what's next. And it's a much more specific definition than you probably think. Okay, so what does being current actually mean here, legally speaking? Because this is a precise legal definition, and your servicer cannot make it any stricter than what the law itself says. Here's the exact legal standard. No payment 30 days or more past due in the 12 months right before your cancellation request date, and no payment 60 days or more past due in the 12-month period beginning 24 months before that same date. I know that's a lot of numbers stacked on top of each other, so let's slow down for a second. Two separate windows here. The recent 12 months, where even a single 30-day late payment can genuinely be a problem, and an earlier 12-month window starting 2 years back from that, where the bar is a bit more forgiving. 60 days, not 30. Now, your servicer might try to layer on their own extra requirements. That happens more than you'd probably think. But there are only 2 additional things they're actually allowed to require of you. Evidence your property value hasn't declined below the original value, and they can require a borrower-paid appraisal for that specifically. And a certification that there's no subordinate lien, like a HELOC, that's eating into your equity. That's it. That's the complete list of extra requirements, in full. Nothing else belongs on it, ever. So if your servicer comes back with some other condition, some other hoop to jump through that isn't on this exact list, push back. Know this definition cold before your servicer ever tries to tell you their own version of it. Now, once you're approved for cancellation, there's actually real money coming back to you afterward. And there's a strict federal deadline attached to that refund. That's exactly what's coming up next. Okay, so here's the refund rule now, and this one genuinely surprises a lot of people. Once your PMI is terminated or canceled, any unearned premiums, money you already paid for coverage that no longer applies, have to be returned to you. And there's a strict deadline attached to that. 45 days. That's it. 45 days from termination or cancellation, and the money has to come back to you. Now, I want to be really precise with you here, because this is not a penalty. It's not some kind of fine on your servicer. It's simply a return of premium timing requirement. You overpaid, briefly, and the law says they have to give that money back promptly. Nothing punitive about it at all, just a firm deadline. Now, there's one exception worth knowing about, and I want to be upfront about it rather than let you assume this always applies cleanly to every single loan. High-risk loans get a different threshold entirely. The Homeowners Protection Act allows a carve-out here where PMI can be required to persist until 77% loan-to-value instead of the standard numbers we just walked through together. So if your loan was classified as high risk at origination, check that classification before you assume the standard. 8078 midpoint framework applies to you directly. Now, steelman your servicer here for just a second, because I genuinely don't want you walking away from this thinking every servicer is out to get you personally. This is genuinely really complicated. Multiple thresholds, multiple exceptions, multiple deadlines, all layered right on top of each other. Servicers manage this across thousands, sometimes millions, of individual loans. And that layered complexity right there, that's exactly where things start going wrong. Consistently, predictably, and at scale. That's exactly what's coming up next. Okay, so I need to correct something on camera using the CFPB's own words, because this isn't speculation. This is fully documented. The CFPB itself has stated it found what it directly calls substantial industry confusion among servicers implementing these exact HPA cancellation and termination rules. Not one servicer either. Industry-wide and confirmed across multiple supervisory cycles back in 2013 and again in 2015. Their own bulletin titled 7 Examples of Unfair Practices specifically and directly lists failure to automatically terminate PMI on time as a recurring examination finding found repeatedly across servicer reviews. The common cause: inaccurate servicer data over and over. Not fraud necessarily, just bad record keeping. Systems not tracking loan balances correctly against that 78% threshold. And when they do get caught, remediation is required. Refunds, staffing changes sometimes. There's more here too. CFPB Compliance Bulletin 2015-03 documents servicers actually conflating the HPA's statutory floor with stricter investor or GSE guidelines, applying the wrong, tougher standard instead of what federal law actually requires here. And separately, they're failing to send the required annual PMI disclosure notices they're legally supposed to send out. Now, I want to be really careful here, because I'm not going to hand you a made-up statistic just to make this sound worse. I could not find a reliable figure for what percentage of requests get wrongly denied or a verified average delay. So I'm simply not stating one. The pattern is well documented. A precise number simply isn't, at least not one I trust. But here's the verdict, plain and simple. This confusion, it's real. It's documented directly by the regulator itself. And in most cases, it's not you making the mistake. It's the system underneath you. So what do you actually do about that? That's exactly what's coming up next. Okay, so here's exactly what you should do, step by step, if you're actually sitting in this position right now. Step 1. Put your cancellation request in writing, always. Not a phone call, not a voicemail. Written, and keep a copy of it for yourself. If it isn't in writing, it basically doesn't exist if this ever becomes a dispute later on. Step 2. Request written confirmation of receipt along with a clear timeline for when you should hear back. Ask for it directly. Don't just assume silence means it's being processed somewhere in the background. Step 3 then. If they deny you, or worse, if they just go silent and ignore you entirely, you escalate immediately. File a complaint at consumerfinance.gov/complaint, or file with your state regulator instead. Both are legitimate paths forward, and if your servicer keeps refusing, even after that, consult a consumer protection attorney. That's a real option, and it exists for exactly this kind of situation. Now, I need to correct something important here, because people misunderstand this constantly online, all over YouTube and forums. Filing a CFPB complaint is not a legal filing. It does not force your servicer to cancel your PMI on the spot, automatically. What it does is prompt a formal investigation and a required response from them. It's leverage, real leverage, but it's not a magic button. So, put it all in writing. Keep every single confirmation you get. Don't let a single phone call be your only record of any of this whole process. Now, everything we've covered so far in this video applies to conventional loans with PMI specifically. But if you're in an FHA loan, none of this applies to you in the same way at all. That pivots exactly what's coming up next. Okay, so if you're in an FHA loan specifically, listen closely, because everything I just told you does not apply to you in the same way. FHA loans use something called MIP, a mortgage insurance premium, not PMI. And MIP is not governed by the Homeowners Protection Act at all. There is no request-based removal path here. None. Here are the actual numbers. An upfront premium of 1.75% of your loan amount, usually financed right into the loan itself, plus an annual premium, most commonly 0.55%, on a 30-year loan with the minimum 3.5% down payment. That's the current 2026 rate after HUD cut it 30 basis points, down from 0.85% back in a 2023 rule change. Now, here's what actually determines how long you're stuck paying it. Put down 10% or more, and your annual MIP cancels automatically after 11 years of payments. Put down less than 10%, and MIP lasts for the entire life of the loan. No borrower-initiated cancellation route. None at all. So for most FHA borrowers, low down payment, the only real exit is refinancing into a conventional loan once you've built up roughly 20% equity. And here's a worked number, illustrative only. On a $300,000 FHA loan at minimum down, cumulative MIP over 30 years is estimated at roughly $49,500 to $50,000 by lender calculators. One bright spot, though, for 2026 specifically. Under the new Reconciliation Act, the mortgage insurance premium tax deduction covering PMI was reinstated for borrowers who itemize, after being phased out since 2021. Treat that as a recent reinstatement, not settled tax code. Okay, I know that was a lot. Really dense. But you stayed through federal law, precise percentages, and every single legal threshold. And that matters, because this is real money sitting in your monthly payment. So here's the refrain. One more time, together. 80, 78, midpoint. Say those numbers with me. The confusion here isn't yours, it's the system's. Documented by the regulator itself across multiple supervisory cycles. So don't wait for your servicer to remember you exist. Check your original loan value right now. Do the math on 80%. And if you're there, or close, send that letter today. In writing. Keep the copy. Now, since you know what to do, please leave a like and subscribe to the channel and check out my other videos. I'll see you there.